Hello, this is Dale. In this video, what I want to talk about are the 4 facts about the market that support my trading strategy. I've been a trader for 35 plus years, hedge fund manager. I've been a guest speaker at a number of trading sites, written 3 financial books, and am the founder of www.optionsinfinity.com, which I will show you at the end of this video. The 4 facts about the market that support and show the power of the 3 principal trading strategy, which specializes in credit spreads, are shown below. The 3 principal trading strategy is a strategy that I have compiled after so many years of trading and looking at what's successful. And I know I want to keep it simple so that I can pass this on to other people that would like to become a success in the market. And this strategy can be used for stocks, for Forex, but I tend to specialize on credit spreads because I think credit spreads are the very best way to consistently bring in monthly income. The first fact is that 95% of all prices stay within the plus or minus 2 standard deviation channel. The second fact is when implied volatility, which is used to establish our credit spread strike prices, is higher than the historic volatility, it's to our advantage. Number 3 is our trade setups have 80 to 90% probability based on option delta. And number 4, since we are a seller of options when we do a credit spread, the fact that 82.6% of all options expire worthless for the 5 markets that I studied is to our advantage. These are all market facts. These are not things that are made up. These are facts that support my trading strategy. Fact number 1, 95% of all prices stay within the plus or minus 2 standard deviation of the regression channel. This is a photo or a screenshot of the regression channel on Amazon. I was using the 1-year week chart, and you can see that the line here is the regression line. This is calculated by taking 50% of the price above the line and 50% of the price below the line. So the regression line is an excellent trend line. Then the green line is the plus or minus 1 standard deviation, and the gold lines are plus or minus 2 standard deviations. Notice how it trades within these ranges. Occasionally it does have an outlier, but it soon is pulled back to the mean. And this is the way trading usually occurs. If we know this fact, we can look at that chart and see when a stock is either overbought or oversold. This is a standard bell-shaped curve, and it shows that if you have a mean that 68.2% of all prices excuse me, will be contained within the plus or minus 1 standard deviation. And then 95% will be contained within the plus or minus 2. And if we go back to this chart, you can see that, you know, it's very evident that it comes up to this plus 2 and it reverts back to the mean. It comes down to the minus 2 and reverts back to the mean. Now, sometimes certain stocks will go plus or minus 1 standard deviation. So it's good to know which stocks you have. But this is one of the most powerful tools that I have used for many years. This is an interesting chart. This chart shows that the plus or minus 2 standard deviations have held for the market since 1900. This is a huge advantage if we know that when a price is overbought or oversold. And you can see from this chart, this is the mean right here, and here is the -2, and here is the +2, and that's where all the prices are held. Fact number 2, when the implied volatility, which is used to establish our credit spread strike prices, is higher than historic volatility, it's to our advantage. Using historical and implied volatility, and I got this quote right from Investopedia. Historical volatility may not be an accurate measure of future volatility when the implied volatility is higher than the average historical level. Option premiums are assumed to be overvalued. This works in our favor. Since we are option writers with credit spreads, it works in our favor. Here's just a chart showing the historical volatility, and I took this, this was February 10th of 2020. You can see that the historical volatility was sitting right around 15.5. And when we set up the credit spreads, you can see that we were using the option chain that was about 68 days from expiration, and it indeed had a higher implied volatility than historical volatility at the time, and that means these premiums are inflated, and that works to our advantage, being the sellers of a credit spread. Fact number 3, our trades are based on about 80 to 90% probability based on option delta. This shows that the implied volatility at this point was 12.26. That's what we use to determine our credit spread strike prices. On the next chart, you can, well, actually, if I take the SPX price on 429.19, and let's go back to that, it was 29, let's say 29.42, okay? 29.42 with the implied volatility of 12.24, that means you had a projected possible move of about 51 points. You can see that right here. That's actually 52 points, okay? So here is the current position that it's sitting at, and based on the number of days till expiration and the implied volatility, this is the projected move, either plus or minus. Once I know that, to set up a bull put, what I want to do is I want to subtract the projected move, in this case it was 51.8, from the current price, and that gives me the level that I want to set the strike price that I'm going to sell. For the bear call, we add the projected move to the current price, and that sets the strike price for what we want to sell for a bear call. And this is the bear call, and this is the bull put if we set it up at this point in time. And notice the large distance away from the current area we are. So this becomes a very conservative trade for us. Credit spreads can bring in consistent monthly income, and it's a very conservative way to do it. You can see that the strike prices based on the implied volatility usually fall between 0.1 and 0.2 on the delta. You can see that this one's fallen right around 0.1718, somewhere around there. Okay, what that means is the delta, if it is 0.2, it's showing that the option has 80% or 0.8, 80% chance of expiring worthless. And this is a tremendous advantage to us. When we go out this far and set up our options credit spreads, we've got about 80 to 90% chance that the option is going to expire within that band and it's going to expire worthless. This is the one for the bear call. You can see that the delta is right around, well, this one was right around 0.15. So what is delta? Delta is a ratio comparing the change in the price of the asset to the corresponding change in the price of the option. So in other words, if I have a delta of 0.2, that means for every dollar move I have on the underlying asset, the option's only going to move 0.2 or 20 cents for every dollar. Okay, and in other words, another way of looking at then is a 0.2 delta means 80% chance of the time the option will expire worthless. Fact number 4 is 82.6% of all options expire worthless within the 5 markets that were studied. And this also comes from Investopedia. They looked at the CME, and we looked at 5 major markets: the S&P 500, the euro dollar, Japanese yen, live cattle, and the NASDAQ. Okay, and they discovered that 4 out of 5, every 5 option expired worthless. In fact, the put options alone, 82.6% expired worthless in these 5 markets. So if you've got a strategy to use to trade credit spreads to try to bring in monthly income, and the strategy, I call it the 3 principles trading strategy, and later I'm going to show you how you can click onto my YouTube channel and go directly into and learn more about the 3 principle trading strategy. I've got 4 facts about the market that support this strategy. First of all, 95% of all prices stay within the plus or minus 2 standard deviation. When the implied volatility is higher than the historical volatility, it's our advantage. The third is our trade setups have 80 to 90% probability based on delta. And 82.6% of all options are going to expire worthless. And these are all to our advantage. These are all market facts that support my trading strategy. Now what I'd like to do is go over to my website, show you a little of the website, and at the end of this, that you can either click on my channel to subscribe, or also click on the first part 1 of the 3 principle trading strategy and learn more about that. So let's go over to my website. It is www.optionsinfinity.com. What you want to do is, I've been in business for 10 years. This is something that I have a great passion for right now. I love to teach people how to become a success in the marketplace. It's a very difficult arena to be profitable and be successful. I know how to do it, and I love teaching people how to do it. You scroll down, this is a PDF. Basically, it's a blueprint of the 3 principle method, and you can view or download this for free. Again, this is written what you can also view on my YouTube videos. You may want to check out some of the testimonials here. You might also want to look at this, how does a mentor speed up your trading success? If you like what you see and you'd like to allow me to become your mentor, you can become part of the community. It's like you're looking over my shoulder and watching me trade, because whenever I see a trade in either the stock or the credit spreads or Forex, I will send out a text and email alert directly to you telling you what I am doing. Well, so we meet once a week. It's about an hour long. I'm the one that does the teaching. I usually teach for about 20 minutes. Then we go over all the trades we have on, what I see coming on in the future. And then there's plenty of time to ask questions and make sure that everybody is totally on board and there are no questions lingering. So there's plenty of time for that. You also get my entire masterclass suite showing you exactly how I trade the Forex market, the weeklies, credit spreads on the monthlies, and credit spreads on the financially strong stocks. I think this is a great opportunity for you to learn from somebody that's been doing this for a long time and is a professional. You can look over my shoulder and you can earn as you learn. I hope you take advantage and subscribe to my YouTube channel, and also go ahead and click on part 1 and begin to learn about my 3 principal trading strategy. Bye-bye now.